Luke, glad to have you with us. What is this deal about? Does it show that PE is back?
Yeah, well, EQT, which is the private equity arm of a wealthy Swedish family, buying Springer, which is a German publishing company, for 2.3 billion euros. Now, they're buying it from another bunch of private equity firms, UK-based Candover and Cinven. Now, both of those firms are making a profit on the deal, about 1.6 times their money. But still, Springer's, it's been in a little bit of trouble. The motivations for this deal are largely financial. Both the existing owners invested from their 2001 fund, and they can't afford to put any more money into the company for its future investment plans. Now, this would have made the company a perfect target for a competitor, a strategic buyout like Informa. But only about a week or so ago, Informa pulled out of the race, saying that the time frame was too tight.
So they said it was a bad move. Is there any question about pricing? Is that part of the reason they pulled out?
Yeah, well, the main thing they said was that the time frame was too tight. Now, this seemed a little bit strange given investment bankers' propensity to work without sleep, but more likely is investor pressure. They would have had to tap the market for a rights issue, and their investors were worried about the increasing leverage. Now, this may work out in the future to be a pretty bad move for them. The current valuation was about 8 times EBITDA, and that compares to about 15 times EBITDA that similar companies were selling for a few years ago. And a few years ago, in the private equity boom, these sorts of industry companies were complaining that private equity was pricing them out of the market. Now that they had the perfect opportunity to pick up a company on the cheap while private equity's in the doldrums, they've passed on it.
Luke, we thank you very much.